Most people have no idea how close they are to getting wiped out. The stock market isn't rising, it's overheating. The difference, one makes you money, the other gets you crushed. Right now, we are not in a bull market, we're in a bubble with better PR. The S&P 500 gave us 61% over the last 3 years. That's not normal, that's not sustainable, that's a warning. But retail investors are treating it like a green light. They're chasing momentum in a rigged environment and calling it strategy. Look at the numbers. PE ratios are inflated. Buffett indicator is maxed out. Credit is tightening. Bond yields are volatile. And the Fed's hands are tied. If you think that ends well, you've already lost. This is how markets break, not with a headline, with silence, with overconfidence, with everyone telling you to just keep buying while the ground shifts underneath them. You're not here for hopium, you're here for the truth, so here it is. You're either playing the smartest game in the world with a plan, or you're gambling like a tourist in Vegas, hoping the slot machine hits before reality does. I'm going to show you why this market isn't what it seems. I'm going to give you the actual levers that matter. Then you decide whether you want to win or wish. Let's get to work. The market is on drugs and everyone's pretending that's normal. Let me give you the hard numbers. The S&P 500 has returned 61% in just 3 years. That's double the historical pace. Nobody wants to say it, but I will. This isn't a rally, it's a sugar high, and it never ends well. You don't double the speed of a system built to grow at 10% per year without consequences. This isn't sustainable growth, it's borrowed time, and eventually that time runs out. Here's what happens next, because we've seen it before. When markets run this hot, the next 3 years don't look like the last 3. Gains flatten, corrections come fast, volatility spikes, and the investors who chase the hype, they eat it. But let me be clear, if you're holding real businesses, profitable, cash flow positive, growing, you're not the target here. You're building something. You survive. I'm talking to the gamblers, the ones riding overpriced momentum stocks with zero fundamentals and calling it a strategy. This is where retail gets burned, not because they invest, but because they invest blind. They buy what's up, they ignore valuation, and then when gravity hits, they act shocked. So ask yourself this, are you holding quality or holding hype? One can take a punch, the other gets knocked out. What you're seeing now is speed without foundation, and the faster you go without structure, the harder you crash. This isn't fear, this is friction. The longer you deny it, the more it costs. You don't need to sell everything, you need to stop chasing everything. Everyone's celebrating the gains, but nobody's asking the most important question. What are we paying for them? Right now, the market is priced like there's no risk, like earnings will keep climbing, inflation will stay tamed, and the Fed will thread the needle. That's delusional. Let's look at the facts. The current PE ratio on the S&P 500 is sitting at 27. The 35-year average, around 16. That means investors today are paying 70% more per dollar of earnings than what's historically been considered sane. And that's not even the scary part. The Buffett indicator, which compares the total market cap to GDP, is at 200%. That's 2 standard deviations above normal. The translation, we're not just stretched, we're warped. When the markets are priced this perfectly, there's no room for bad news. One earnings missed, you're getting crushed. One inflation surprise, watch valuations contract. One rate spike, say goodbye to that safe multiple. This isn't about being bearish, it's about understanding the setup. You're standing in a house made of glass, pretending you're safe because it hasn't shattered yet. And this is where people get it wrong. They confuse momentum with value. They think it's still going up means it's worth more. No, it just means more people haven't left the party yet. Markets can stay irrational longer than you can stay solvent, but eventually math wins. And when it does, the people who overpaid are the ones who bleed. So here's the question. Are you buying real value or are you paying a premium for perfection? Because perfection doesn't last, and when it breaks, it doesn't correct, it collapses. The people with real money, many are leaving the party quietly, while retail is still taking shots and calling it a strategy. Look around. Warren Buffett's holding $350 billion in cash. Funds are lightening up fast. Bitcoin just broke all-time highs, and it's not because your cousin bought more on Coinbase. That move, that's not retail. That's smart money getting out of fake assets and parking it in hard ones. They're not selling because they're scared. They're selling because they're not stupid. And here's the part nobody tells you. Money doesn't disappear. It moves. It looks for safety, for leverage, for a better setup. Right now, it's moving out of overpriced hype and into conviction plays. That's why Bitcoin's ripping. It's a middle finger to the system. No board, no earnings call, no CEO screwing it up. It doesn't need your belief. It needs your exit. Meanwhile, what's retail doing? Doubling down on momentum trades, FOMOing into stocks that already ran 80%, buying garbage with no profits, no plan, and no clue. This is what a transfer of wealth looks like. The rich sell when it's quiet, the broke buy when it's loud. Here's the playbook. Retail always shows up late. Smart money never waits for headlines. If it's on CNBC, it's already priced in. So yes, keep chasing last year's winners. Keep pretending this run never ends. But understand this, by the time you hear the story, they're already gone and you're holding the bag. The charts, they look okay. The economy, it's bleeding out behind the scenes and nobody's talking about it. Let's rip the Band-Aid off. Consumer sentiment just dropped from 74 to 50. That's a collapse. Household debt just hit $18 trillion. That's a record. Credit card delinquencies are at a 10-year high. The translation? People are broke, maxed out, and pretending it's fine. You don't need to be an economist to see it. Just walk into a grocery store. Prices doubled over the last 2 years. Inflation supposedly cooling, but nothing actually got cheaper. And wages? They didn't catch up, which means people are still underwater, just quieter about it. But here's the real killer. The U.S. credit rating got downgraded. Moody's just slapped America down from AAA. Why does that matter? Because when your credit sucks, borrowing gets expensive. And guess what Washington runs on? Debt. Every 1% increase in interest rates costs the U.S. an extra $350 billion a year just to service the debt. That's not going to schools or roads. That's paying interest like a broke teenager with 6 credit cards. And the Fed, stuck. If they cut rates, inflation comes back. If they don't, the debt spiral tightens. Either way, this isn't bullish. The problem isn't just the market. The problem is the system. When the government, the consumer, and the corporations are all over-leveraged at the same time, you're not in a cycle, you're in a setup. And when the floor gives out, it won't be gradual. It'll be sudden. That's how leverage works. Everyone's playing offense, nobody's playing defense. And that's when games get lost. Everyone's got opinions. Here's what matters. Should you be buying right now or sitting tight? Let's split it. Here's the bull case. The S&P 500 has averaged 10 to 11% returns per year for decades. If you miss just 10 of the best days in the market over 20 years, your returns drop by half. 94% of decades finish green. That's not luck. That's time and discipline doing the work. And if you're holding great businesses, the odds tilt even harder in your favor. Now the bear case. The market's trading at a 27 PE. That's expensive. When you buy in at stretched valuations, the next 3 years usually suck. Flat returns or worse. The macro's ugly. Costs are rising, GDP is slowing, consumers are tapped out. This is not a friendly setup. So what wins? Here's how you cut through the noise. Follow the free cash flow. If a company can grow its cash flow right now in a high-cost, high-rate, tariff-driven mess of an economy, it's not just strong, it's elite. That's the difference between a business and a bet. Free cash flow is what's left over after everything. It's real money. You can reinvest it, you can buy back stock, you can survive. No free cash flow, no cushion, no control, no thanks. So is this market a buy? Not for hype chasers, but for people focused on owning cash flowing machines that print when others panic? Yes. If the market tanks, those companies get cheaper, and that's your shot. You don't need to guess the bottom. You need to start owning businesses that generate cash no matter what Jerome Powell does. That's how you win this game. This isn't a panic moment. This is a positioning moment. I'm not running, I'm watching, and I'm waiting for fat pitches. Not chasing overpriced hype, trying to look smart on Twitter. Here's what I'm asking before I buy anything right now. Is this business getting stronger every quarter? Are the revenues, contracts, and cash flow growing even in this environment? Is this company becoming harder to compete with or easier to ignore? If the answer is yes across the board, then it's on my buy list. Right now, I'm not deploying heavy capital. I'm building my watch list, stacking cash, and setting triggers because we're in a setup, not a breakout. You don't go all in when valuations are high, sentiment is euphoric, and everyone thinks they're a genius. You wait until the math makes sense. But when that window opens, I'm not hesitating. I want free cash flow trending up, revenue beats with margin expansion, products that dominate categories, not trend for 30 days and vanish. That's what I bet on. I'm not timing the market, I'm timing my entries. Big difference. If the business is strong and the price gets crushed, that's not a loss, that's a discount. Weak hands panic when prices drop. Strong hands wait for quality to go on sale, then buy hard. So here's the play. I'm staying patient, staying liquid, and staying sharp. And when the market hands me a deal I can't ignore, I'm stepping in with size. That's not gambling, that's execution. And let's be real, most people are still out here guessing. They're reacting to headlines, chasing hype, and wondering why they're stuck. Meanwhile, I'm stacking cash, hitting targets, and playing offense because I actually have a plan. This year, I'm already up over 780,000, and we're not even at the halfway point. While retail is buying garbage, I'm buying quality, and I'm doing it in real time. If you want to see what that looks like on the inside, I break it down daily on Patreon. Here's what you get. Real-time trade alerts, not after-the-fact recaps. Daily breakdowns of the market, short, sharp, actionable, my exact option trades for weekly cash flow, no guessing, no fluff. That's the edge. You don't need another guru, you need a system. One that's working right now, not just in theory. If you're serious about leveling up, join the Patreon. If not, no hard feelings. Just don't act surprised when the people who did are way ahead of you in 6 months.